So just to summarise the issues around community energy, I mean, the advantages almost speak for themselves. You've got local people investing in a local asset. You have a nice sort of cooperative structure. We have, some of our minimum investment was £250. Our largest investors who participate in the public and the private round have £75,000. Both of those get one vote. So, it isn't a traditional commercial structure. People aren't looking on this as buying shares. They're looking at it as participating in it as a member of an entity. Obviously, less local objections and those kinds of things, and certainly if you set up a project from scratch as a community project, you would expect to have less problems in planning. And also, there are quite a lot of sort of soft benefits in terms of the people participating, actually then doing stuff at home and being more aware of sustainable energy. Disadvantages are, you're starting off with a group of people who are just no more than local enthusiasts. In many cases, they don't even know anything about energy. They're not paid to do it. They've got day jobs. They've only got a limited amount of time. They've got no money available to them, and that makes the whole decision-making process very slow. And it's actually very problematic, very difficult to get a local energy project up and running in any given time. The timetable tends to stretch and stretch and stretch. And I'm pleased to say that I'm now involved with an entity that's been set up to try and overcome some of these problems, which is an entity called Communities for Renewables, actually based down here in the southwest. And what they do is help communities, and they provide actually some capital, at-risk capital, and expertise to help communities get projects up and running, and then assuming the project succeeds and gets away, then Communities for Renewables is paid a fee for that, and if it doesn't, Communities for Renewables says, well, we all tried. So, it isn't easy to do, but it's wonderful when it all works. And now over to you.
This is the West Mill sort of cash flows. The lines that you can see on there are the actual cash flow income lines. The blocks are the expenditures that go through. What you'll find is index-linked bonds have been issued quite continually for the last 27 years, primarily by utility companies. They're issued by entities who have got an index-linked revenue stream and therefore can match their repayment profile to what income they receive. Hence why utility companies are ideal for undertaking index-linked bonds. The West Mill Solar transaction, obviously under a FIT regime, also has index-linked revenue streams. So again, looking for a pension fund in order to sort of cover off that sort of risk as well, because a pension fund also likes to have index-linked revenue stream. If you think about it, a pension fund's got an index-linked liability, so it's looking for that kind of cash flow. This is a perfect match for them. Now, when you look at that chart that you can see in front of you, just explain it a little bit for you. The orange chart block, that's all the O&M expenses. The green is the index-linked payments to the pension fund. And the rest of the cash flow is either sort of reserves or tax or equity payments that are going out. And you can see that the thick line that you can see right in the middle of the blue box, that is the FIT revenue stream. And as you can see from there, that is perfectly indexed and perfectly matches the repayment profile. In the event that indexation reduces during the time period, then the obligations under the bond reduce as well. So you have a perfect match there. In the event that inflation increases, again, you'll be paying more to the pension fund. So that was sort of the kind of structure that also was very, very similar to the British Renewables transaction that Angus discussed this morning. But really, at the end of the day, it's probably an easier sale for the point of view of FIT payments rather than ROC payments. That's what I want to talk about next. One of the issues with Western Solar was just the size. And this is where it becomes an interesting issue. That was a 12 million bond issue. To be honest, it became very clear that if we had 50 million of sort of a bond issue to place, that would have been far easier. There is no lack of capital available in the market. It's just getting the right attraction at the right time with investors. Now that one you go, well, I'll just put the same slide up, but rest assured it isn't. That is anybody who's got a range of UK solar deals under ROC payments at this point in time will have a graph similar to that. That's still over 25 years, as the previous one was over 25 years. Again, pension funds would prefer to see 30, 35, 40 years of revenue stream rather than something that's shorter. The drop-off of the revenue streams at the back end, that's when the ROCs drop off. And if you look at the lines, the first line that's on there is your power revenues, and your top line is your ROC revenues. I've structured in there an index-linked bond, again, just to see what that could do. But to be honest, I'm not convinced that's a deal that can be done in the market. And I say that purely and utterly from the point of view that the power revenues, which accounts for a significant portion of the revenues, more so than on a FIT project, are not necessarily perfectly index-linked. They are on that graph. They are on that graph purely from the point of view, the way that we look at those deals is look at a power price that is a low to mid-low to central power price from Puri or Redpoint or one of those consultants. And that takes a mid-low price of about 47 a megawatt and inflates it over time. So it looks lovely on that particular graph. But in reality, power pricing isn't as that certain. And also in reality, you're only going to get a power price contract for probably 3, 4, 5 years. You get your ROC contract for 15 years. It's a slightly different risk profile for any investor to take it and accept it. It does not mean to say that pension funds aren't interested in this kind of structure. It's just going to be a sort of a slower process than you would see with a FIT-related transaction. Now, what is happening in the market, there is a lack of real opportunities for pension funds at this point in time. Other kinds of deals that they've done in the past aren't there at this point. So there will be some pension funds that get their heads around this kind of structure, but believe you me, it will take a little while. It will be easier when there's a larger size of issuance to be done. And we're looking at either putting something out like that or something similar in the market. There is obviously upsides because the power revenue could go higher, and that's not missed on pension funds. There is a number of downsides. Again, there's merchant power risk there for 20 years. It's uncertain where the ROCs will go post the normal 15-year contract. So there's a number of variabilities in there that doesn't necessarily give a stable revenue stream and a stable position for investors in the market. As I said, there's a number of investors out in the market now who's looking at renewables as a sort of class in itself. If you recognise that 3 years ago there really wasn't a renewable market in the UK, many investors haven't got their heads around what a renewable project would look like. So gradually we're seeing more and more investors getting comfortable with renewable transactions. So there's definitely equity out there, there's construction debt out there, there's certainly long-term debt, and there's unlevered buyers who will buy the whole revenue stream, the whole entity from the original developer. So effectively, it's an emerging market, and I would see more interesting products and investors developing again over the course of the next 2 or 3 years. Of course, people will have seen a bond issued for Greencoat which is a wind transaction. So you can see the market is gradually sort of picking up. Whether we can replicate index linking is another story altogether, and for the obvious reasons that I've outlined, and whether we can segregate out the rocks independently from that is another structural question that we have. My presentation was effectively designed around, can we repeat the West Mill solar transaction? The answer is love to. Bring another fit transaction to us, and the answer would definitely be yes. There's just challenges with rock and power transactions. But without a shadow of a doubt, what we are seeing at this point in time are many developers looking to aggregate transactions, and we are seeing a number of community projects, which I'm pleased to see as well. Thank you.